Going to talk about incorporation today, and we'll start off with what is incorporation. So incorporation is going from being unincorporated to being incorporated, and when we're looking at being incorporated, there's two forms of incorporation. There's either a limited company or there's a limited liability partnership, which we'll call an LLP for shorthand. And when we're unincorporated, we're not one of those, which means we're either a sole trader or a partnership. And the question is why would one want to go from being a sole trader or a partnership to an LLP or a limited company, or why wouldn't one want to go? So there are both commercial and tax benefits to both scenarios, and from a simplicity point of view, the two that are closest are a partnership and an LLP, the limited liability partnership, because for tax purposes they are identical, but one is unincorporated and the other is incorporated. And I'd like to start by just comparing those two. So why would you want to switch from being a standard partnership to an LLP, or why would you wish to stay as a standard partnership and not incorporate? The principal benefit of the LLP is, as the name says, it does what it says on the tin, it's limited liability partnership. That means that if the business goes bump with significant liabilities, that those liabilities stay within the LLP, and that the partners of the LLP have no personal responsibility for those liabilities beyond what the monies that they actually have in the LLP. At the moment, if you look on the news and you read about companies going bump, you see that suddenly at the time that they go bump, they owe people millions and millions of pounds. And if they would be a partnership, unincorporated, the creditors could go to the owners of that business and say, we want that money. Sell your house, sell your assets, you have a liability to us and you need to pay that off. If it's a limited liability partnership, there is no need to do that. As long as you haven't done anything illegal, the liability stops at the boundaries of the partnership, the limited liability partnership, and does not go to the partner's own personal assets. And that is principally the main reason why anybody would incorporate. And it's a very good reason, because in business, things happen. That's life. And even with the best planning, people can incur very high liabilities over a very short period of time through no fault of their own. I was once dealing with a limited company, as it happens, so it did have an element of protection. Limited company where they had employees on site on a shift basis. One of the employees took them to tribunal and claimed that because theoretically while he was on site, even though he wasn't working, he could have been called out in an emergency, that he should have been paid minimum wage for 24 hours a day, 7 days a week when he was on site, which was significantly higher than he was being paid. He was being paid a good wage for an 8-hour shift, but it wasn't triple the minimum wage. He ended up with a very high claim. The tribunal upheld that claim. The company couldn't afford it. They actually went into liquidation. When they went into liquidation, all the other employees suddenly made similar claims, and the liquidator was faced with millions and millions of pounds worth of claims from employees, which suddenly materialised literally out of nowhere. And with the best will in the world, there was no way the employer could have foreseen or predicted that. And had they been a partnership as opposed to a limited company, they would have had to honour those liabilities themselves personally from their own personal resources that they built up over years. As it happens, their liability was limited to the value of the company, to the assets that were left in the company, which was still, in that case, a relatively significant amount, but nothing like the level of liabilities that would have come on them had they not been incorporated. So that is the primary reason why we advise people to incorporate, because it protects them. So why wouldn't you incorporate? So what are the disadvantages of incorporation? And there are two main disadvantages of incorporation. And then there's the third reason, which is probably the reason why it doesn't happen most of the time. So one of the main disadvantages of incorporation is that once you're incorporated, an LLP has to submit accounts to Companies House, whereas a partnership doesn't submit accounts to anybody other than the Inland Revenue and its own partners. So there are some people who wish to keep their business affairs private. They don't wish the world and their wife to be able to Google, or more simply do a search on Companies House, and actually see what the value of their business is, what they've got in the balance sheet, or if it's a bigger business, even its profit and loss account. So there's a privacy issue which is there with a partnership but not there with the LLP. So that's one of the reasons why some people don't incorporate. The other reason is that a partnership is relatively flexible. It's governed by its partnership agreement, which doesn't even need to be in writing, and to add and to remove partners can be done relatively simply without actually the need to tell anybody. On the other hand, LLPs have a register of members which is declared at Companies House, and that information is on public record, who your members are, when they joined, when they left, and there's a lack of flexibility. There is more flexibility with the partnership than with the LLP. Whilst you can do the same in both, there isn't the paperwork with the partnership that there is with the LLP. So those are the two reasons why I would think that people don't incorporate. But I think in reality the reason why it doesn't happen is because it's easy to set up a partnership. That's how you start. You start either as a sole trader or as a partnership. You one day get up and think, I'm going to do this. I'm going to start selling widgets on the market, or I'm going to offer my services doing, I don't know, hand car washing or whatever. And you get 6 months, 12 months down the line and you suddenly think, oh, I need an accountant. And that's the point that they come to us and they're already established. And then it's a matter of change, and really inertia probably stops the change. But from a practical point of view, the simple benefit of incorporation, that protection, is really very simple to avail. Certainly in the LLP format, if you don't fancy being a limited company, you can go down the LLP format and you get the protection very simply at very little cost. So that's why, as a whole, we do recommend people to incorporate either as an LLP, but more commonly as a limited company, because there are several advantages of a limited company over the LLP. So if we look at the advantages that you get from a limited company that you don't get with an LLP, there are several. The first one is a bit of a strange one. It's one that I've never understood, but it's fact, is that when it comes to credit ratings, the credit agencies who rate businesses, which is more and more important these days, because when you want to deal with somebody, they will go to their insurers and say, can we deal with these people? If we sell to them and they don't pay us, will you cover that debt? There is more and more trade insurance going on, and that trade insurance is governed by insurers who look at the credit rating of the people you want to deal with and decide whether they're going to cover it. And for some reason, they like limited companies. They would give a higher credit rating to a limited company than to the individual that's behind it, or the individuals that are behind it, which is daft. Because the individuals, everything that's in the company, the individuals own, but they've got their own assets beyond that. But for some reason, the credit agencies seem to think that limited companies have a certain kudos to them, even though companies register is now well over 10 million. We're growing at a rate of 1 million companies every couple of years. It costs 20, 30 quid to set up a company at Companies House, not even. So there's no great shakes about having a limited company, yet the credit agencies prefer them to individuals, to partnerships, and therefore from a practical point of view, if you set up as a limited company, certainly over time the chances are you will get a better credit rating than if you're trading as an individual or a partnership, which will then allow you to increase your trade and develop your business. So it's a very practical reason for being a limited company as against an LLP or unincorporated. The other thing about a limited company is that there is a separation between the ownership and the management of a business. So with a limited company, you've got the ability to bring in other people as shareholders, and if planned from the start, you can have what's called different classes of shares and different rights for different individuals, which you don't have with an LLP or a partnership. There, everybody is of equal standing. You can have a small amount of flexibility with regard to income and capital. You can have different rates of return for the income element and different rates for the capital element, but by and large, certainly in an unincorporated partnership, all partners have a right of management. In an LLP, it's slightly restricted, but there is still not as much flexibility with ownership as there is with a limited company. So a limited company would allow for a family to set up a company with shareholdings to different members and different generations of the family, allowing them to take out different amounts with much greater flexibility than an LLP and certainly than a partnership would allow. So there's the flexibility from the structure that's one of the reasons why people go for the limited company as opposed to an LLP. It's a far more flexible vehicle. There is also another thing that one can do with a limited company that one can't do with an LLP, and that is set up a group structure. And if you have a holding company with a trading company beneath it, one can annually move the profits out of the trading company into the holding company without any consequences, not tax or otherwise, provided that you believe that the trading company is solvent at the time that you do it. And if at some future date a disaster were to happen to the trading company, the monies that are in the holding company would not be at risk to the creditors from the creditors of the trading company. And if the monies had been lent back to the trading company for practical purposes, but with a debenture, which is a charge on the assets of the trading company, that would again give priority to that money being repaid over general creditors. So if we go back to the case of the client that I was telling you about earlier, where the workers came and had this massive charge, had they had a limited company on top of it, a group structure, with the assets being in the group structure, even that money would have been protected from creditors. One cannot set up that structure as easily in an LLP, and certainly not in an unincorporated partnership where everything goes back onto the partners. So there are two principal non-tax reasons there for going for a limited company over an LLP. Three. One is the credit rating, and then there's the protection and also the flexibility. So those are the three non-tax reasons that you would go for a limited company over an LLP. If we now look at the taxation system, the LLP is a look-through vehicle for tax purposes. So basically the income of the LLP is apportioned straight away to the owners of the LLP, and they are taxed on that income as if they were a normal partnership, which is subject to income tax and the Class 4 national insurance regime. A limited company is treated as its own self-contained body, it's its own legal entity, and it is taxable on its profits. If it pays a salary to directors, then depending on the level of that salary, you might have employers' national insurance and employees' national insurance. If it pays out dividends, those are after-tax payments to the shareholders, and they're again then separately taxable on the shareholders. But one of the main advantages of a limited company over an LLP is that a young company, a growing company, is a money pit. It sucks in money like a black hole. And most of what you earn is actually repumped back into the company to allow it to grow. I have the philosophy that I advise clients: if you look after your company when it is young, it will look after you when you are old. But you need that to look after it when you are young. And because with a limited company, when you extract the money out, you have a double taxation system. You have the corporation tax, which is currently 19%, and then it comes out to you, and then you pay potentially a higher rate of tax, certainly a minimum of 7.5%, but possibly 32.5% to you as an individual. Whereas if you're in an LLP, that money is taxed upon you at your 40% if you're a higher rate taxpayer, again plus national insurance, the appropriate national insurance rate. But what happens if, let's say, you've got quite a profitable company, earning £60,000, for example, a year, but you live off £20,000 and the other £40,000 you would want to invest back into the business, subject obviously to taxation. Within the limited company structure, you will pay a lot lower tax initially because the money that's left in the company, those profits are only taxed at 20%, as opposed to the LLP partnership route where they would be taxed, the surplus profits would be taxed at 40%, which to a young growing company where cash is essential means that you've got the ability to grow. At some later stage in life when you want to take that extra money out when the company no longer needs it, it will be a further tax, but it will be delayed and it will be when money is less important. In the initial stages when money is tight, the limited company route is a much better route for allowing you to retain profits within the business rather than the LLP route, which is another reason why when people set up, they go down the limited company route rather than the LLP route. To change back at a later date when it might be more efficient to be an LLP is quite an expensive process, and therefore people don't undertake it, which is why the limited company is far more popular than the LLP route, although for certain types of transactions historically the LLP route was seen as a better vehicle, predominantly property investment, and still is. If you're looking at a commercial investment business, you might be better off in an LLP in the long run than you will be in a limited company. The other reason that people tend to use the limited company over being unincorporated, and it's highlighted as the main reason, but it actually isn't, because as I've explained there are many more reasons why we won't do this, is that there is seen to be a tax advantage. And there are plenty of examples, we've done them ourselves many times, where you can do a fixed amount of income and say how much tax would you pay if you earn that under a sole trader or a partnership, and how much tax would you pay under a limited company, and you can look at it and see the advantages. There are two main areas where there is still an advantage in a limited company over a sole trader or even an LLP, because it's treated as a sole trader. And the ranges are round about the cusp or just over higher rate tax. So we're talking about £45,000, and if we go all the way up to say £60,000, because at that point you're also losing your child benefit. And the reason why the limited company is actually better is because if we look and say, well, we're going to extract all the profits, so we're not looking at a scenario where monies are being saved within the company, but we're looking at all the monies being taken out. So if we go with last year's rate of £45,000, because it's a nice easy figure, being the cusp of higher rate, and you're earning £60,000, you've suddenly got £15,000 that's being taxed at higher rate down the partnership unincorporated route, plus you're losing all your child benefit. So there's quite a cost of earning that extra £15,000 from 45,000 to 60. If we go down the limited company route, because the limited company is going to pay corporation tax, which will be somewhere in the region of about £10,000, depending on the level of salary, etc., and costs. As an individual, your salary is only £50,000. Your salary and dividend package is only £50,000. So instead of being £15,000 into higher rate, you're only £5,000 into higher rate. The other £10,000 has been taxed at corporation tax rates, but that's effectively only 20%. So you're effectively getting another £10,000 of nil rate, of basic rate band. On top of that, because you're only earning £50,000, you're not losing any child benefit at that stage. So at that level, if we took an example of somebody earning £60,000 and we put it through a sole trader as opposed to a limited company, there would be a large tax benefit in the limited company. And you get a similar effect at the £120,000 level, where somebody earning £120,000 as a sole trader would lose their nil rate band with a cost of £4,000, whereas in a limited company, because that £120,000 would attract £20,000 of corporation tax, you then have your personal earnings at just below the 100,000 and you're not losing your nil rate band. So those are the two areas where there is a big tax advantage in being a limited company over a sole trader. But the truth of the matter is, none of us can predict what the earnings are going to be in the future, and those are the two main areas where there is a benefit. Be outside of those, the difference is actually quite small. If you're a basic rate taxpayer earning up to £30,000 or £40,000, there's very little to be saved. There's a small amount, but we're talking hundreds of pounds. As you get beyond it, as you go between £60,000 and £100,000, dividends have an inherent, what I would call, national insurance. They have an extra 7.5% that was introduced a few years back by the Chancellor, which was to counteract the main benefits of limited companies, because there was no national insurance as against a sole trader who pays class 4. So he introduced this 7.5% charge, but that 7.5% charge is unlimited, whereas on a sole trader, once you get to higher rate or just under higher rate, the rate of national insurance changes to 2%. So there's a clawback. The limited company is actually more expensive because it's inherently got a lot more national insurance charge in it. So we get this pocket of benefit from about £45,000 to £60,000. Then it starts getting clawed back as you go towards 100,000. Then you get another pocket of benefit at the 100 to 120,000, and then that gets clawed back. And in actual fact, if you have a really profitable partnership, and let's say it's one where, again, because of the nature of the business, it doesn't need any capital, and therefore all the money's being taken out, once you get to sort of the £195,000 area, which I know is a lot of money and puts you in the top 1% of earners, but once you're into that bracket, actually it's cheaper being unincorporated as opposed to being incorporated in a limited company. So yes, for the vast majority of people, there are tax advantages of being in a limited company as opposed to a sole trader, but by and large, that's actually relatively limited, and the real advantages are not the straight out comparisons. If you earn X under one method and the same amount under the other method, you'll pay a lot more, a lot less tax on one of those methods, because the government have spent the last 10, 15 years trying to iron that out. And as I say, apart from a few small pockets which are anomalies in the system, they've relatively managed to do that. Where the advantages of the limited company lie in its flexibility. So in actual fact, if as a sole trader you earned £100,000, you would be taxed on that 100,000 yourself. If you're in a limited company, you might be able to have different classes of shares, spread that money across family members, and therefore take advantage of multiple nil rate bands, of multiple basic rate bands and be able to lower your tax bill. But it's not because the limited company is taxed at a different rate, but you've got a flexibility of the structure. And the other main area, as I said earlier, was typically if you're earning £100,000, you're going to be wanting to leave 20, 30, £40,000 to grow the business. If that 40,000 is being taxed at higher rate, personally, that's going to cost you £16,000. If it's being taxed in a limited company, it's going to cost you less than £8,000. So there's an £8,000 saving on £40,000 being left in the business, which is quite a significant government contribution towards the growth fund of your business. Does anybody have any questions? So I think we've cantered through the reasons why one should incorporate as against unincorporation, the differences and the benefits. Thank you.